Iran just struck U.S. military bases in Kuwait and Bahrain. Brent Crude surged 24% in July. But here's the twist nobody's talking about. OPEC Plus just approved a production increase of 188,000 barrels per day starting September. The Strait of Hormuz remains completely shut. We are heading into the Asia-Pacific session with Brent at $90.12 and the market at a critical inflection point. I've got 3 exact trade setups with precise entries and stops in the full breakdown. I'm not telling you to buy the breakout. Watch the full video to see why. The geopolitical heartbeat of the global oil market just went into overdrive. Late last week, Iran's Islamic Revolutionary Guard Corps launched airstrikes against U.S. military facilities at Ali Al Salem Air Base in Kuwait and Sheikh Isa Air Base in Bahrain, targeting power generators, navigation systems, and support buildings. This wasn't just another skirmish. This was a direct strike on American assets in the Gulf, and the market reacted exactly as you'd expect. Brent Crude surged nearly 24% in July, closing the month at $90.12 per barrel, its strongest monthly run since March. But here's the trap most traders are walking into this week. While the headlines scream escalation, the fundamental picture is quietly shifting beneath the surface. OPEC Plus just approved a production quota increase of around 188,000 barrels per day from September, completing the unwinding of voluntary output cuts that date back to 2023. And the Strait of Hormuz? It remains completely shut, with Iran's fast news agency stating clearly that the waterway will stay closed as long as the United States continues its hostile actions. This is the tension that defines the week ahead. Supply shock meets supply response. Geopolitical premium meets OPEC Plus adjustment. And the price action at $90.12 is telling us something that most retail traders are completely missing. Why weekly verdict is straightforward. Brent Crude is bullish biased but dangerously overextended into resistance. The trend structure is constructive while price holds above the weekly pivot at $89.24. But I am not chasing this move at current levels. The invalidation level for the bullish thesis is a clean daily close below $88.40. That breaks the ascending trendline support and forces a re-evaluation of the entire setup. Let me be crystal clear about what I'm watching. The market is pricing in a significant geopolitical risk premium, but the Williams %R is sitting at negative 16.20, which is heavily overbought territory on the short-term charts. I've seen this exact divergence 3 times in my career. Twice it led to a violent reversal, once it didn't. Here's the tell. It depends entirely on whether the geopolitical headlines continue to escalate or we see any sign of diplomatic de-escalation. What stands out to me is not the headline price at $90.12, but the way the market is compressing volatility into a tightening range ahead of the weekly open. The ATR is at 2.01, which is elevated but not extreme, and the ADX at 28.45 is just beginning to signal a strengthening trend. This tells me the market is coiling, not collapsing, and the breakout direction will be explosive. Let me walk you through the technical landscape starting from the weekly timeframe and working down. On the weekly chart, Brent is trading well above all major moving averages. The MA5 at 89.85, MA10 at 89.20, MA20 at 88.10, MA50 at 86.40, MA100 at 84.95, and the MA200 at 81.20, all signaling buy conditions. The RSI sits at 64.80, which is bullish momentum firmly intact but holding below the 70 overbought threshold that would trigger a deeper pullback. The MACD is showing positive divergence at 1.15, confirming the macro buy signal that has been building throughout July. Moving down to the daily chart, we are seeing price action consolidate above the critical $90 psychological milestone after the explosive July rally. The CCI at 112.50 confirms sustained bullish expansion territory, but the stochastic at 78.40 is approaching the overbought threshold that has historically preceded short-term reversals. The daily structure shows key resistance at $90.80, $91.82, and $92.27, with support layers at $89, $86, and 79 cents, and $85.24. The 4-hour chart is where the real story unfolds. Price is holding above ascending baseline structures with a constructive consolidation pattern developing directly below the L1 resistance level. The 4-hour momentum is still bullish, but I'm watching for any bearish divergence to develop on the MACD histogram, which would signal exhaustion at these elevated levels on the 1-hour chart. We are seeing neutral to bullish price action consolidating near structural range highs into the weekly open. This is the classic pre-breakout pattern: tight compression, decreasing range, and building tension. The breakout from this consolidation will likely define the direction for the first half of the week. The cross-asset picture is equally important here. The US dollar index is trading with a slight bid, which historically acts as a headwind for dollar-denominated commodities like crude oil. And the Brent WTI spread is widening again, which typically signals supply tightness in the global market versus the domestic US market. Let me start with the news that matters most this week because the fundamental landscape is where the real opportunity lies. The geopolitical situation is fluid and dangerous. Iran has not only struck US bases in Kuwait and Bahrain, but they've also attacked a tanker off the coast of Oman near the Strait of Hormuz. President Trump has threatened more strikes on Iran as the United States presses for the reopening of the strait. Meanwhile, Iran has denied reaching any compromise deal with the US on opening the waterway, with officials stating flatly that there is no agreement. But here's where it gets interesting for traders. OPEC Plus approved a production quota increase on Sunday of around 188,000 barrels per day from September, completing the unwinding of voluntary output cuts. This is significant because it signals that the producer group is responding to the supply shock, even if the actual physical impact of these increases remains limited due to ongoing export disruptions from the Gulf. The calendar this week is packed with high-impact events that will move this market. On Monday, August 3rd, we have the global ISM manufacturing PMI releases, with the US ISM manufacturing PMI expected to show activity expanding with a headline reading of 54.0, up from 53.3. This is a critical gauge of global energy demand, and any miss to the downside could trigger profit-taking in crude. Wednesday, August 5th, brings the global services PMI releases alongside the EIA crude oil inventories report. The previous week showed a massive draw of 716,700 barrels, far exceeding the expected 127,200 barrel decline, with total U.S. crude inventories now sitting approximately 6 to 7% below the 5-year average. This inventory picture is incredibly tight and provides a structural bid to prices regardless of headline volatility. The other ongoing risk event is the Strait of Hormuz situation. Reports indicate that Iran has tightened restrictions on navigation through the strait, limiting the movement of vessels linked to the US and Israel. The UK Maritime Trade Operations has reported tankers being struck by projectiles off the Omani coast. This is not a theoretical risk. This is real supply disruption that's already impacting global oil flows. Now let's get to what you're really here for, the actionable trade setups. I'm giving you 2 scalping strategies for the intraday trader and 1 swing trade for the medium-term outlook. Scalping setup number 1. The bullish expansion. The first scalping setup targets a bullish breakout above the intraday resistance at $90.80. Here's the trigger. If price breaks cleanly above $90.80 on strong volume and holds the breakout, wait for the initial 5-minute pullback to retest the level as support. Execute long positions on that retest confirmation entry, $90.85, on pullback confirmation, stop loss, $90.45 take profit 1, $91 to 40 take profit 2, $91.82 risk to reward, 1 minute and 1.4 seconds on TP1, 1 minute and 2.4 seconds on TP2 invalidation. Failure to break above $90.80 or a break that reverses back below within 2 5-minute candles. Scalping setup number 2. The bearish mean reversion. The second scalping setup is a counter-trend mean reversion trade. If price rejects $90.80 on an exhaustive volume spike, meaning we see a massive volume bar that fails to hold the breakout, initiate short scalps targeting the daily pivot point at $89.24. Entry, $90.75, on rejection confirmation, stop loss, $91.10 take profit 1, $89.24 take profit 2, $89.00 risk to reward, 1 minute and 1.5 seconds on TP1, 1 minute and 1.7 seconds on TP2 invalidation. Price breaks and holds above $91.10 or we get a fresh geopolitical headline that triggers a gap higher swing trade setup, the tactical entry the swing trade is where I believe the real opportunity lies this week. The foundational assumption is that the bullish market structure remains intact while holding above the key support shelf at $89. However, the heavily overbought oscillator conditions heavily warn against chasing entries at current market highs. The tactical entry corridor is simple. Patiently wait for a structural pullback to test the intersection of the $89 support level and the weekly pivot point at $89.24. This is a high confluence zone where multiple technical factors align entry, $89.10, on 4-hour bullish reversal confirmation, stop loss, $88.40 take profit 1, $90.80, R1, take profit 2, $91.82, R2, risk to reward, 1 minute and 1.3 seconds on TP1, 1 minute and 1.9 seconds on TP2 invalidation. A clean structural daily close below $88.40. The confirmation trigger I'm looking for is a 4-hour candle that prints a bullish engulfing pattern or a long lower wick, confirming buy-side defense at the support level. I want to see buyers step in aggressively at that zone. Now here's something I've learned from 2 decades of trading these markets. The best trades are often the ones you don't take. If we gap higher on Monday morning on fresh geopolitical headlines, I'm not chasing it. I'll wait for the pullback. The market always gives you a second chance. What stands out to me is that the risk-reward on the swing setup is asymmetrically favorable. We are risking 70 cents to make $1.70 to $2.70. That's the kind of trade I build positions around. Risk management is not an afterthought. It is the foundation of survival in this business. With the ATR at 2.01 and geopolitical volatility expanding, position sizing is critical. I never risk more than 1% of my trading capital on any single setup, and in this environment, I'm sizing even smaller. I learned this lesson the hard way back in 2014 when I was long crude into an OPEC meeting that caught the entire market off guard. I had sized my position based on technicals alone and completely ignored the political risk. That trade cost me 6 figures and taught me that no technical setup is worth blowing up your account. Your stop loss is your insurance policy. Place it and forget it. Do not move it wider because of fear or greed. The stops I've outlined, $90.45 for the bullish scalp, $91.10 for the bearish scalp, and $88.40 for the swing trade, are non-negotiable levels based on structural support and resistance, not arbitrary numbers. Let me leave you with the key level to watch this week, $89.24. That's the weekly pivot, and it's the line in the sand between bullish continuation and a deeper correction. As long as we hold above that level, the path of least resistance remains to the upside. A break below it, and we are looking at a test of $86.79, and if you found this breakdown valuable, check out my analysis on gold and the US dollar from earlier this week. I've linked them in the description. The correlations between these markets are going to be critical in the weeks ahead. One final thought before you go. The geopolitical heartbeat of this market is pounding harder than anything we've seen since the Gulf War era. Supply shocks, OPEC responses, military escalation, it's all happening simultaneously. The trader who stays disciplined, respects their stops, and waits for confirmation will be the one who profits. The trader who chases headlines will get chopped up. Trade smart, manage your risk, and I'll see you in the next one. By the pullback, not wait $4.89.00 $89.24 zone stop at $88.40 first target $90.80. Second $91.82 pin. Comment what's your read on this market. Are we looking at a continued melt up toward $92 or a sharp mean reversion back to $89? Drop your levels below and let's discuss. Also, which asset should I cover next week? Gold, Bitcoin, or natural gas? If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis, and then loop back to today's Nasdaq Gamma flip later.